Vanguard, but it's important to know that that's where you're going to get the fully matured indexes, and prices are moved up a little bit because a lot of people want them. But Schwab, Fidelity, iShares, or someone else might have a smaller fund that's now going in a new direction. Let's say AI or something, and they have a fund that does nothing but that. Vanguard's not going to touch it until there's like billions of dollars in the market. Then they'll come up with their AI fund at a lower fee and then take all the business. But we'd rather look at some of these other companies also for cybersecurity, is that I don't want all my eggs in one basket. So if you create a brokerage account, and you could do that at Vanguard, it's a good idea to have some different companies there, because each one custodies the money with their exchange traded fund or fund. And if Vanguard gets hacked, if I'm going to hack somebody and I'm a bad guy, they're probably the biggest one, right? If they got hacked, I would rather have a variety of different companies and different funds for cybersecurity, number one, and then funds that are different from each other, number two, and then funds that might not be hosted by Vanguard yet.
So when I go on the Vanguard website, it will allow me to select Vanguard only funds. So you can buy iShare
Yes.
funds through Vanguard and Schwab funds through Vanguard?
Yes. The caveat is, though, you have to set up a Vanguard brokerage account. And so kind of like a Schwab brokerage account, but you set it up at Vanguard, and they may or may not charge you a fee to buy their competitors' funds. Now, if it's a mutual fund, they'll charge you a fee, possibly. If it's an exchange-traded mutual fund, as I call it, they probably won't, because and whoever's listed on their platform, whether it be Vanguard, Schwab, or anybody else, if I have a new mutual fund and I say Vanguard or Schwab, here, put it on your list for your people to buy my mutual fund through you. Well, if they say, well, it's not cool anymore to charge a fee to buy the funds to the public, we're competing and we're not doing that anymore. That's how Schwab put another company out of business. They waived their fees, and the other company didn't, and they couldn't afford to waive their fees. So Schwab bought them out and merged them in together because the other company was going to have a tough time. Anyway, the way that Vanguard or Schwab or Fidelity's brokerage accounts make money is that when you put money in the cash account, they pay you 0.25% today and they make 3%. So it's like, hurry up and make up your mind, because you're not going to make anything on this. Kind of like a bank, right? And then when they have funds on the list, those funds may have to pay a fraction of their management fee to the company. So if Vanguard has a mutual fund on a Schwab platform, Vanguard says, we're not giving you part of the management fee. And Schwab says, but if you want your mutual funds listed here, we got to make something. So then they do charge you to buy a Vanguard mutual fund. Now, the exchange traded fund, they can share a tiny bit of that fee, and then they make spreads and all that kind of stuff.
So what's a brokerage account versus another kind of account?
Another kind of account would be you sign up all the paperwork, and you have to do Vanguard only mutual funds. At the end of the day, they'll buy the fund for you. But now things have turned a little more speedy, and so Schwab and Fidelity and everybody has brokerage accounts that you could buy mutual funds everywhere, but also stocks and bonds, and you can buy or sell during the day. Now, a regular mutual fund, you can only buy it or sell it at the end of the day. But an exchange-traded fund is a similar asset that you can buy and sell during the day. So if you go to Vanguard and set up a brokerage account, then you can buy and sell stuff immediately, or at least put in an order for a mutual fund to be bought at the end of the day.
So correct me if I'm wrong. The brokerage account has everything that a regular account has, plus what you just described.
Yeah, you can buy all their competitors. There might be another little fee to, like if I go to Schwab or somebody and I want Vanguard mutual fund, and Vanguard won't pay them a hostage fee, then they're going to charge me $10, $12 to buy that fund because they need to make some money somewhere.
So the money I was talking about is in Vanguard. Okay, so but then you're saying, well, I could go to a brokerage firm and they could buy Vanguard. So
yes.
So Vanguard, being that I'm with Vanguard, they only invest in their own Vanguard funds, right? They're not a broker.
For the most part. However, they do have a brokerage account you can buy and set up through Vanguard and buy all their funds with no fee or anything. No,
That's separate from
Or you still got to look for 403?
Yeah, it's a
Okay, well, I think
403B.
the employer, correct me if I'm
Yeah.
wrong. Sounds like the employer is, and that plan, is the Vanguard client, not you, per se, for that money.
Right.
Is that?
Correct. Yeah. The employer has, that's why you have the delay. Now, you might have Vanguard funds in a 403B, but the employer has the obligation to manage all that. And if you want to leave, you tell them, look, I want to do a rollover into an IRA, let's say. And then they'll fill out everything. And for whatever reason, you have to wait 6 weeks or so.
Is it not true that I thought maybe I had to, I was no longer with that employer?
Depends on their plan. Their plan might say that you have to, or it might say if you have less than 3,000 that you need to get the money out. So it's up to whatever that plan says. But you can roll the cash over. Some cases maybe the stocks or something, but if you roll over the cash to an IRA at Vanguard, they'll have you just buy Vanguard mutual funds. But Vanguard wants people to give that up and start using their brokerage account. Because it's kind of like if you're a real estate broker and the blockchain comes out and somebody calls and says, I want to buy a piece of property and I want it now. If a real estate broker is on the blockchain, they could get on the computer and you could buy your house like that, right? But traditionally, if the broker wants to sell you a house and they've got to go through the escrow and all that other stuff, and then maybe this thing falls out of escrow, they're not loving it. So Vanguard has to do a lot of paperwork behind the scenes when you send them a check or wire them money saying, buy me this. They wait until the end of the day, then they have to buy it or sell it. And it's a lot of paperwork. Vanguard would love to have all their funds be like an exchange traded fund where they don't have to do the stuff behind the scenes. You just buy those shares from other investors in the open market, and that reduces their costs and all their work. So when the blockchain does grow to the point where it's everywhere and regulated properly, you want to buy a house, you'll be able to buy it within a couple of days. Yeah. And if it's secure that way, that's fine. Real estate brokers, you got somebody who's all excited to sell it. You don't want to wait, 3 months and have the deal fall through type thing. So going to Vanguard, you can have just a Vanguard mutual fund account, but they would like you to set up their brokerage account because then it reduces their paperwork behind the scenes and they can, there's not so much work. Because when they manage a mutual fund, they've got to have enough cash. If you say, I'm selling my shares back to Vanguard, give you your cash, or, oh no, everybody wants to sell, then we've got to sell stocks and bonds, and that ticks people off during tax time. They would rather just manage the fund, and each little share is bought and sold through your own brokerage account somewhere over here. And so Vanguard ultimately is trying to get out of the mutual fund business. They may have a small legacy group of them, but they want to be in the exchange traded fund business. Kind of like they don't want to be in the warehouse business, they want to be on the retail tabletop type thing, and it reduces a lot of their expenses. So a lot to it, isn't there? But it's empowerment if you really, really want to do it, and if you have somebody else doing it, you'll know what they're doing. Especially a family member, because sometimes they get all excited. If you have some idea, if you're too busy to deal with it, or someday you're not going to do it, you have some idea of where things are going. But the good thing is most everything is becoming more transparent. In the old days, when I started in 1980, there were very few fee-based asset managers or financial planners. The public just wanted to buy something, and they paid a commission, and after a while they didn't, but the fees were higher. So this is just narrowing it down and give you a better view of it. The thing about a portfolio, remember a portfolio is made up of, in our example, is a variety of mutual funds or exchange traded mutual fund. Each one is a separate basket, kind of like a carton of eggs and then a different carton of eggs and a different carton of eggs. Each fund has its own characteristics and its differences. That gives us the ability to not buy one stock and risk losing it, but maybe we have one mutual fund that has 500 stocks in it, the S&P 500, or the total stock market index that has maybe 1,800 stocks in it. So a fund, in our opinion, is safer because it's safer in numbers, not guaranteed that you won't lose money if you sell when the market's down, but we don't have to worry about one stock going out of business if we've got 2,000 or 3,000 stocks in the portfolio among 10 different investment funds. So what we talk about is creating a new portfolio that has internal securities in it, but a variation or a variety of funds and exchange traded funds, and then multiple companies like I mentioned. So if we have internal securities of like 3,000 stocks and there's more bonds out there, 10,000 bonds within a variety of funds that are different from each other, because if one's down, we hope the other's up or not down as much. And then multiple fund companies for whatever reason, cybersecurity, they have different ideas or different options. You'll hear of iShares, which is BlackRock. They have probably the most amount of exchange traded funds, and they have a lot of different ideas. If you don't want to just buy a fund in the S&P 500, which is like almost a third technology, or total stock market, which has 1,800 stocks in it, and that's too boring, maybe you want something a little more specific. And so there'll be a fund out there designed for that. Today, the hot thing is AI, right? Okay, that's fine. There's funds that seek that out, or others that seek out infrastructure for data centers. And so you can buy a fund and say, I want to be a part of that, but you don't have to risk it in buying one stock. You can buy an exchange traded fund that has 45 different stocks that build data centers and nuclear power plants. So you can narrow it down to specifics without taking the risk of one stock. So individual securities inside all those funds, all the different funds that are different from each other, and then the different companies to reduce the risk of the things that we mentioned. Short term, when you create a portfolio or you have a bunch of mutual funds, we like to look at it kind of like a roller coaster that gets higher and higher, or a diving board that gets springier. In the beginning, some of the money in a portfolio or in your group should be cash, right? If you have a huge tax liability, instead of CDs, we recommend go to the government website and buy T-bills because they're state tax free, right? If you have a lot of real estate and you have a lot of state taxes, now you're going to be able to deduct not 10,000 but up to 40,000. So that's nice. But if you or anybody you know has a ton of money in CDs at the bank because they want them to be safe, one, I'd lock them into 6 to 1 year. Rates might be falling, obviously. But the other thing is that if you go to the government website, treasurydirect.gov, you can buy your own T-bills. Now they're federal taxable, but they're state tax free. So if that's a thought and you want control, treasurydirect.gov, I would go to YouTube and learn about it, and then learn how to sign up for it from watching YouTube, so you don't get so frustrated because it's a government website. It's not a friendly, Charles Schwab, Fidelity. It's not easy. But you end up being able to buy T-bills, whether they be 1 month, 3 months, 6 months, or whatever. And usually T-bills you buy at a discount. So if it's a 5% T-bill for a year, you buy it at 95 cents on a dollar and it matures at $1. If interest rates fell while you held it, you could actually sell it to somebody else at a profit if you wanted to. But that's just to satisfy that itch of, I'm not investing this money. I want to keep control of it. I don't want to worry about it. In my opinion, the Treasury is probably safer than FDIC. FDIC would have to raise the money. Help, we need money. The Treasury can print money, but that's just my opinion. So we obviously want to keep some short term in cash or treasuries or something like that. There are funds out there, exchange traded funds, that will buy Treasury bills that are within a 0 to 3 months. So if you don't want to be buying them and then buy them again when they mature, you can get an exchange traded fund. There's one that has a symbol of BIL. I don't remember who does that, but it might be Vanguard. Vanguard has one. Very short term, put the money in. T-bill matures, they buy another one for a month or 2 or 3 months. And you could sell it at any time and likely not lose any money because they're very short term. There's no reason for them to drop in value. Bonds can drop in value because if you buy a 30-year Treasury bond today earning 4%, great. You could sell it to me, and if I want it, I'll pay you what you paid for it, fine. But if rates go up and I could get a new one at 6%, why would I on earth buy your bond, right? And you've got another 29, 30 years to wait for it to mature or sell it to me if it only earns 4 when I can get a new one at 6. So then the resale value of your bond goes down, right? But the opposite is true, that if I buy a 30-year Treasury at 4 and then rates drop down to 2, everybody wants my 30-year Treasury bond, especially grandma that needs the income or pension plans. So they'll pay me a profit, and I'll be able to brag about how I made money on that. But now I got my capital gains, but I'm not going to earn any more than 2 on the new one. So it's a dilemma going back and forth. And that's why everything about investing, if you have legitimate investments that are going to be fair and treat you right, it's all about your particular situation. It's all about the planning process as far as getting the result that you want. Because we could all gamble about, and I've got a college intern, he goes, oh, we listened to so-and-so. This guy made a fortune, hedge managers, hedge fund managers. But you have to look at they're massively gambling. And some of them go out of business, you never hear from them. So the investment process is putting a square peg in a square hole for you. And that has to work for you. If we didn't have to worry about volatility, or if we didn't have to worry about time, then we'd all buy nothing but stocks. But if you need money next month, next year, 3 years from now, or the market crashes and an emergency arises, that's the part where we have to plan this out. It's like driving a car from California to New York. If you absolutely knew you weren't going to get in a wreck, why would you need seat belts, airbags, any safety issues? But you don't know that, so we have to plan those. So cash reserves, intermediate term bonds, those are kind of like an intermediate term reserve. So short term would be the cash, intermediate term might be 3 to 5 year bonds in a fund, in an exchange traded fund. They earn a little bit more, or ultimately will. And if rates fall, the cash yield will fall quickly, and the intermediate term bonds, meaning bonds are going to last 3 to 5 years, maybe 6, they'll hold that yield longer. So if you want to lock in yields, then instead of everything being in ultra short-term rates, you move it out a little bit. But it's risky, because what if interest rates go back up? What if inflation comes back? Then the long-term perspective are stocks. So if we go back to 1900, and if all you had is cash, bonds, and stocks, then cash short-term, bonds, intermediate, stocks long-term. Obviously, you have thousands of other choices now. We like to look at things to balance things out in a...
I have a question.
Yeah.
So you broke it down in cash, bonds, and stock. Where does T-bills fall?
Cash. Yeah, that would be considered cash and things like that. And the main thing is you have money at the bank already for short-term or comfort or whatever. And yeah, you could buy T-bills if you don't want to pay state taxes on it. But that would be considered cash, especially if the T-bill's like 1 month T-bill, you could sell it and get out of it quickly. And do we all need a lot of cash on the side? If I have a secure pension with the government and I've got all kinds of assets, probably not so much. But if I'm living off my investments and my rents and things like that, I'm going to tend to have a little more cash, because you never know when you get a call from the property manager saying, guess what? You have to do it. Yeah.
I think synthesize too, that's helpful.
So we like to look in 3 different stages. We have them. This was the slide I mentioned on Nash last time. Are we going to fix this one? It's backwards. Yeah.
Notice that 2, 3, 1.
Yeah. I am dyslexic and left-handed, but yeah. So we like to do things in 3 stages when you put together either one portfolio or look at all your stuff. Stage 1 is made up of short-term stuff, 0 to 5 year horizon. CDs are fine. T-bills, bank savings, ultra short-term bonds. That could be 2%, 5%. No, I'm going to buy a house next year. 50%, depends. And that's where a lot of people get into trouble, especially in my business, is if I get a call and somebody says, hey, I'm thinking about buying a house for my daughter or something in 6 months, then we need to sell off stuff and scale back, because there could be a big storm by the time you go to buy that house. So whatever you might need in the short period of time, it's a good idea to have some short-term assets there. But again, if you don't have any ideas or any plans, and you've got a secure government retirement and everything's fine, then very little there. It's up to you. You're not planning to make a lot of money there. Then the stage 2, when we go over here to a little bit longer term, then that's individual longer term or long-term bonds. Individual stocks could be there, but we'd like to be a little bit more conservative. Mostly managed mutual funds and index funds and things like that. Could be a little bit more aggressive if you want, but we are looking for 3 to 10 years to give it time to recover if it drops. And then the 5 to 10 years would be individual investments that we don't need liquidity. They provide liquidity, but they carry a lot more risk. And then long-term bonds and balance funds and things like that. Now here's where we've got it mixed up. Stage 1 is cash. Stage 2 comes all the way over here to bonds and balance funds. Sorry about that. And then the long-term one's in the middle. So that's the one with long-term bonds, individual stocks. So we did that just to mess with you. So cash, and then 5 to 10 years over here, things that could take a little bit of bruising. And then stage 3 is 10 years or more. Okay. We're just making sure you're awake. Okay, so when you've got all of your investments, real estate would be more in that third stage, right? So your cash, your balanced mutual funds, things that could take a little bit of a hit. That, let's say Vanguard has a balanced index fund or something. If the stock market drops 20%, it might drop 10 or 12 because it's got stocks and bonds in it. And so cash, stocks and bonds, or all bonds if you want, and then just stocks over here and real estate or business, whatever else that you have. And none of this stuff is extremely difficult, but you've always got to be thinking this new tax law change is going to affect me. If it is, and I'm going to get the write-offs, convert to a Roth if I want to reduce future mandatory distributions. But if I'm still in a high tax bracket, why convert now? Because it's just going to be more taxes to pay. There's a million things to be thinking about. And so when you hire a CPA or an advisor, you're just paying them to think about it and get their head wrapped around it, help you figure it out. You can do that. And we always joke, if you want a new career, we'll get you studying, because there's a lot of people that are retired that have no idea about anything. And they're the ones that fall for either inappropriate investments, high commission turnover scams, or out and out scams. And we need to reach out, and if you have neighbors or family members, keep an eye on what they're doing. Not that you want work, but there are jobs for younger people thinking, maybe what do I want to do for a living? They could take some courses and get certified or licensed with the state and become a trustee for somebody. I have one hired for one of my clients. He has some dementia, so we had a trustee come in, and she pays all his bills and has his property maintained and does everything. That's a new career for the younger people wondering, I don't want to go back to college for years. They could get licensed in that area and insured and manage people's bills. It's just...
You mentioned if you got friends or neighbors. You know, financial planning is like a social taboo. You don't go to your friends and neighbors saying, hey, you know, get into this, you know. So it's difficult. And the few times that I have, I've taken the approach of, do you use a financial planner? And kind of see where it goes. But, you know, it's a difficult subject to bring up because, you know, nobody wants to talk about money.
A lot of people get defensive because maybe they made some bad choices and didn't do it, or they didn't invest and they haven't gotten where they would like. But but if anybody says, I don't know what I'm going to do with grandma, she's forgetting things, and I don't live in town, what am I going to do? They can hire a trustee like a CPA or somebody. They'll charge you $100+ an hour, but they'll handle everything. Or invite them to come to the class. But it's hard because sometimes we get cranky. I'll call clients once a year and talk to them, okay, you got this, you got this, you got this. But if I go off topic, how about life screening? Have you had that done just to make, well, I'm not going to worry about that. I'm going to just wait for symptoms to show up. And I'm thinking, okay, I'm not going to go in that area. But we do need to look at all this stuff while you're still relatively young, so you might be able to head it off. I don't know. So yes, people get somewhat defensive in that. One thing I don't talk about is politics. Okay, so when we talked about the short-term, intermediate, long-term, that's pretty much common sense, but we call that lateral integration. So money that for, like, let's say a college student, they're going to be more here because maybe they're ready to spend the money. Or your parent is 95 and they might need $10,000, $20,000 a month for long-term care. Some can do it cheaper than that. So you start moving things back to cash if it's going to be spent. But if it's going to not be spent and we carve out money for the grandkids, then that's more long-term. So a time frame. We should call it space-time. I'm almost understanding that. Not quite, but then we have a vertical integration, and it looks like a pyramid. And when you've got your portfolio set up, let's say a brokerage account somewhere where you could have all these different funds, then we have a plan on how to do it. We layer an imaginary pyramid into 3 levels so the base is bigger, right? And that base of funds that we encourage you to buy are all low-cost index funds, right? They just buy one of everything, and it has the lowest expense. Fidelity has the lowest cost total stock market index fund, 0.015, kind of like a loss leader. It's very inexpensive. They actually have a few free expense funds, but you have to have all your money with them, or at least a big account. But this lower basis, most of the funds, we'd like to have them Vanguard, Fidelity, Schwab, iShares, whomever, the biggest, largest index funds out there, because the larger they are, the lower their expense ratio, right? Now, they're not going to be buying and selling, so they don't need to be agile to get in and get out. The size works for you in that it reduces the expense. And if you want to be just safe, if you wanted a total stock market index that has small, medium, large stocks of all kinds and everything in the market, then Schwab has one, Fidelity has one, Vanguard has one, iShares has one. And say, great, Bill, I got one of the same, but at least if somebody gets hacked, not all my money's in one company, right? There's other total bond market index funds that have one of everything in the bond market, and that will have the lowest expense ratio. And so this lowest part of the pyramid is for money that we're just going to generically warehouse the money, buy one of everything, whether it be total bond market or total stock market, and just walk away. I don't want to do anything else. You'd probably be fine. I saw a client, I think yesterday, when we did an annual review, and I went back and she started, we had like a 60-40, 60% stocks, 40% bonds. But now it's 70% stocks because they've gone up in value over the years. And I looked back and I thought, okay, I'm going to sell off a little bit, just move a little more to bonds just in case. She's unemployed, her husband might retire soon, so we just want to take some of the risk off the table. Market looks really good, and I can tell you all the reasons I think it'll go up, but as soon as I do that, it may go down. So to be responsible, I said, let's move a little bit into the market. I go back and look at her account's history of performance. The biggest fund is a total market index fund with one of those companies. It's up 318%. Now that's since like 2010. But if you had just invested and walked away, her biggest performer was just an average of everything. Now on the way down, when the market crashes, it will fall just as bad. So then you want to have some bonds or balance funds or something else to buy you some time if you had a problem with that. So that's the base of the pyramid. Now the next part of the pyramid are those funds that are a little bit more specific. For example, down here you might have the S&P 500 fund. We buy one of all 500 stocks or total market. But what if I want an S&P 500 fund that isn't all weighted over to technology? Because the S&P 500 fund will buy Apple, but they'll take whatever percentage it is of the total market, which is like 5%. So you have like 7 stocks that make up like 30% of the S&P 500. It's
So I have a problem getting my head around what you just said.
okay.
How it's gone up 300%, but if the market drops, it's going to take a dump. Well, if you didn't have as aggressive, that didn't go up, then you wouldn't have the total amount. So even if the market goes down, you still have more money than you did in 2010.
Absolutely.
So I don't understand
Yeah.
that part of
Yeah.
it. I mean, you understand what I'm saying?
Yes.
I mean,
Yeah.
invest in the S&P 500 goes up 15% every year. For the last 15. Even if it drops, it's not going to drop below where she was before.
Well, we say that it's not going to, and it likely wouldn't drop below because she has so much time and so much accumulated gain that even if it drops a third,
Accumulated gain.
Yeah.
Yes.
yeah, you're fine, right? However, and we have other assets that didn't drop or didn't go up as much, but they were there as a seatbelt and an airbag. So that's why I say,
but they're making much less. They're making 3, 4, 5% or whatever.
if it's a bond fund, some of them, that one made, I don't know, 15% a year or something like that. Others may have made 9, 10, 12 or something. But that's what I said early on is it's the time frame. If I could put you in a time capsule and wake up in however many years that would have been, then you're fine, all stocks. But what if we need some money in the middle of this, right? And so if her husband retires and then she's retired and the market does drop, that 300 is now 150, you and I would say, don't worry about it, that's not a problem. But she's worried about it when the overall portfolio drops. So then you capture that gain by moving some of that excess gain into something that's less volatile. So if you're getting closer to the edge of the cliff saying, I'm going to use the money and cash it out, then maybe we want to take our profits, happily so, and park that somewhere so I could use it. But if she's not going to touch it and that's for the grandkids, then that's absolutely where you'd be. Actually, do one better, we would be in Vanguard's small growth stock index that buys small companies that are very aggressive and all in tech. And it could be up or down 40%. But if we think from now until 30 years from now, who cares? You probably make more money. But if we think now until, oh no, I need some money, then we've got a serious problem. And the problem with that fund is all that gain, and it's now the biggest fund, I might sell off a little bit, but I don't want to trigger a lot of capital gains as well. Now, when we go back to funds like that, Total Stock Market Index has small, mid, and large company stocks. You can buy the S&P 500 and look at the numbers. It's been fantastic. Unless you bought it the day before there's a big crash and you need it a year or 2 or 3 years later.
And
that's the problem. So that's why I said before, the financial planning or investment financial planning is critical to place the right investments in the right location, right? So if I'm in war and I give you the wrong ammo and you go out and it doesn't work, you got a problem. So it's putting a square peg in a square hole for all this. But the Vanguard, Fidelity, or whomever, small stock growth fund 30 years from now, fantastic. If you were just going to work and I say, first year, put everything in cash just in case you get laid off. Second year, every month buy the so-and-so small cap growth fund. And if it crashes 50%, tell everybody you're really excited because you're buying it at half price, right? And you're buying it up, down, and over time, you make some profits. And as we get older, we start toning it down if we're going to rely on those funds for our self-made annuity, right? But we don't get a second chance. And in 2008, remember, the stock market dropped 65% intraday, and it was down 50%. And it took 6 to 10 years for all the funds to come back. So if it's your long-term 10-year or more, that's great. S&P, all these other things, small cap, anything like that. But if it's in between or short-term, then we just put a square peg in a square hole. So you're absolutely right in the long term. I wish I could say that to clients in the market. Could say, what's the problem? I have to come up gently saying, guess what? You're down 10%. Oh no, that's terrible. The stock market's down 28%. Oh, I feel pretty good. And the people that we work with aren't the actual investor, because if you were to say to me, I want go in and buy XYZ stock, and I say, well, why don't you set up a Schwab account and buy it on your own? I think you'll be happier. Because if it's my idea and it drops, you're not happy. It's your idea, no problem. You're confident I'm going to hang in there all day long. So that's kind of how we do it. It's kind of like when you're in a car and you're coming up to a stop sign, you start putting on the brakes and slowing down if you're going to live off this stuff. Now, if you're absolutely not going to live off it, then we reverse it and invest it for the next generation. So that's why it's so fun. You're never going to get bored if you do this yourself. And if you have somebody else do it, you still have to learn all this stuff to make sure they either don't make mistakes or not. Because there's advisors in this business, they're not actual advisor, they're a broker that sell things for commission. That's fine. Others charge you a fee. That's fine. But just do something for what you're getting paid for. You wouldn't pay a roofer in advance, right? And a lot of these commission products, and they say you don't pay it, but the insurance company, no, you're going to pay the cost back to the insurance company. So you would pay somebody a little bit at a time. The good thing about having a fee-based advisor is you pay them each month a little fraction, 0.1% or less per month. And if you don't like them, you fire them, and you're not in for the next 15 years. So the pyramid, the total stock market indexes, and if you do nothing else, that's fine, but maybe different companies. And then the next one is, let's say an S&P 500 fund that would normally be down here, but instead of being allocated based on the size of the company, and Apple and Google and everybody gets most of the index, they equally weight all 500 stocks. Equally weighted. So Apple would be 1/500, Google would be 1/500, and you have an equally weighted S&P 500 fund. And it's kind of like a total stock market index, but it's 500 equally weighted. Or you can buy an S&P 500 fund up in the second level that they say, we're only going to buy stocks in the S&P that have the highest dividends. Good, I'll buy that. And the expense ratio won't be 0.10, it'll be 0.15, 0.20, a little bit more, because they have to do something. Then when you get into some others, there might be a S&P 500 dividend appreciation fund. They'll look at the companies in the S&P, and this is probably one of the best areas, that are growing their dividend each year. So they're becoming more efficient, more profitable, a little bit better. That's a really sweet spot I would recommend people look at, because they're improving their operations, right? And they're reducing their costs. What would be a big thing to cause companies to reduce their costs, improve their efficiency and profits? I'll give you a second while I grab some water. What's going on now in the news that they might apply to their operations that could help them improve everything?
Say the question again.
What are companies looking at to add into their operations to make things more efficient? AI, right? So if I have a dividend appreciation fund with a company that I think is doing a good job, I don't want them to just buy one of everything. I want them to go out, look at the books, inspect the companies to see which ones they think are going to apply AI appropriately and might have a better outcome. So that way, you don't have to worry about, I'm going to go get into AI. I'm going to buy the companies that are going to put AI to work and be efficient. We just did a lecture at Sac State for a bunch of graduate students, right? And they're studying to be a certified financial analyst versus certified financial planner. An analyst is the nuts and bolts of running the numbers and doing all the analytical stuff, right? The financial planner relies on them to manage the fund or do things, and then the planner puts a square peg in a square hole, meets the client, and works with them on a personal basis. Well, these people, the advice I gave them is get your CFA certification. That's really hard. They have to calculate everything by hand. But at the same time, get the certified financial planner so you can get involved in a firm where you meet the people face to face. Because AI can put them out of business very fast, but they can't put me out of business. When I could tell you stories, as anybody in business could, of clients that you've met and all this stuff, and they need a human being, right? I know how to shake a hand and not break a 95-year-old's hand. I know how to lightly, hug them. Though it's going to be a while before AI could do that. So dividend appreciation is what most funds are called. And that, it just lets you know that somebody's looking at the company to make sure it's more efficient. And we're not having them look at, gee, I think this is going to be a hot stock. It's how is this company operating, and are they, it's like an efficiency inspector. And I have a lot of my money in those companies I've mentioned. I like that because they're out watching out for me. So it's not just S&P 500 fund, but it's the companies in the S&P or on the market that are becoming more efficient. So as I talked about, the base of this is total low-cost index fund. Total stock market is one, and any other kind of index funds at the base of that pyramid. Level 2 is more specific indexes. Those could be categories like utilities. There are index funds that only buy utilities, right? So if you want to get into utilities because data centers are going to require a lot more, or there's a big demand of energy for that, utilities have gone up in the last couple of years because of the anticipation of AI and energy and all that type of thing. So you can get an index fund with all the companies we mentioned that only buys utilities. And there's some utility funds that won't buy like the energy of oil and gas. They separate that out. So there's different ones you can go to. Vanguard's going to do a utility fund that's just generic utility index fund because they're not going to reinvent the wheel. But iShares might have an index fund that excludes oil and gas, but it does more nuclear or something else like that. So this mid-size of the thing, you can also do energy and technology and a variety of other things. There may be in that middle size, smaller portion of funds, a multi-index exchange traded fund. So this one, if you said, to heck with buying one big index, I want to buy an index that is the total US stock market index, the world index, the global, and in any other small companies, mid and large. You want a little bit of everything. So there are companies out there that will go out and buy index funds from Vanguard, Fidelity, and Schwab and combine them in their funds. So you might have a fund with all kinds of different companies. Maybe you just want to buy one. You just have to spend a lot of time following it, but small cap, mid cap, international classes. So depending on how much you want. Because if somebody says, just buy the S&P 500 and forget about it, that works at the end of 10 years, 15 years, 20 years. That works. But within that time frame, it doesn't if you have another 2008 and it drops 65%. And that's when people panicked and got out and put it into cash, and then the market came back up. But if you're a long-term investor, volatility is not a worry. Just be diversified. Be in a legitimate investment that's not going to go out of business. If you buy one stock that's great today, it could crash tomorrow and you're done. But if you buy one exchange traded or mutual fund with 45 or 2,000, you reduce the odds of total loss at that point. So you can be as risky as you want with market trends, and oh no, I've got to hold on to it. I bought one stock when Intel crashed. Oh, okay, I'll help them out a little bit. It's down another 30%. So either do you cash out, it's in a retirement plan, I don't get a write-off, or I'm going to wait it out, that they just gave the government 10%. Does that mean the government's going to put them out of business, or are they going to give them contracts? Who knows? But it was like, I preach funds. I have tons of funds. And the one time I try a fund, what happens? So you don't want to gamble on one fund unless you can afford to take the loss. And if it's a legitimate company that you think is going to come back, you can keep buying more. But in Intel's case, it didn't do any good. So we like to be contrary and say, I'm going to buy this and brag to my friends that I bought it when it was down. But when it keeps going, it's not so fun. The S&P will recover over time. And like I say, I can't guarantee that the stock market's always going to go up. But if you look at it, with more people being born every day, going to those stores and for services and goods, they're going to keep producing, even if there's a delay in a big crash. And likely, as long as the population grows, unfortunately for the earth, you're going to have more people demanding goods and services in the companies that you own. But the problem is we never know which of those is going to do really great because it's based on popularity and people speculating that this particular stock's going to do well. They bought it low, it went up, good for them. But if you buy it high and it doesn't pan out, it goes back down, it may never recover. So long term, go for it. Intermediate, short term, I would say have some plans for those types of things. More examples of the middle part of the pyramid: ESG funds, environmental, social governance. So if you want to have an S&P 500 ESG fund or just an ESG fund that is going to exclude certain stocks that you don't like, then there are funds out there. And Vanguard doesn't have very many, but iShares has a lot more. So you have to do your homework at that point. There are some that do smart beta, meaning they passively manage the funds. They might buy a fund with a bunch of stocks in it, but they buy ones that have something called low beta, meaning a little bit less risk compared to other stocks like themselves. Procter & Gamble would be a low beta, lower risk stock than some tech stock, right? So you might want to have a bunch of stocks, but I'd like to have a fund where they try to exclude some of the higher risk funds that might get me hurt. So that's one choice that you would have, and you would pay a little bit higher fee. They have a computer program that rebalances it, let's say, quarterly. There's a different one, strategic beta. If you wanted to get into this stuff, read it in the book, or that other class goes into a little bit. Or there's rules-based investing. So all that is if you said you're going to hire a family member or have a family member do it or an advisor, they do rules-based investments. If you tell them, look, here's the time frame I have on this, that's one rule. Here's the risk tolerance, meaning ups and downs temporarily my stomach can take. That's another rule. Here's, I don't like these kind of companies. That's another rule. And they plug all those things in, create a portfolio for you that matches what your comfort level is. Because again, if I could put you out and into a time capsule, I don't have to worry about your emotions. But you're going to look at your statement every month or quarter, And if it starts dropping big time, you're going to want some answers. And so what I like to ask a client is, okay, let's say you gave me $100,000. You see in the news the market tanked, no fault of my own. How do you feel if all of a sudden you look at your statement's worth 90? That's not a problem. Okay. How do you feel it's worth 80? Well, mostly not a problem. Okay, 70. Well, I'll take a big breath and, just hang in there. How about 50%? Oh, that's too much. Okay. We all have to deal with our fears. And if we can diversify the portfolio as much, mostly we're worried about market trends, not am I going to lose all my money, right? If you buy an S&P 500 fund, it's down 50%. Historically, we would argue up, hang in there, buy some more, don't worry about it. But tell that to people in 1929. Took them 12 years. If they had a diversified index, which they didn't. They had individual stocks, many of which went out of business. Or in what was it? Was it the pandemic? No, it was 2008 when the real estate market crashed. Had the government not lent companies like American General Insurance or AIG money, annuities would have gone out of business. That would have been really bad because people expect those to be safe. So we want to look at the short-term, intermediate, long-term horizon, and then the pyramid, we're halfway up to where saying, yeah, these total market index funds are fine, bonds and stocks, but I'd like to get one that gets me more dividend-paying stocks or allocate it among all the stocks or do anything different. And there's a bunch of things that you could end up doing. These are all the things that if you end up having an advisor manage the money, they should be familiar with all these terms. If they're not, and you love them and don't want to leave them, send them to us and we'll talk to them and get them through this, or send them to our class. That would be cool. We've taught other advisors before. It's really good for our ego. It's like we had one room with 100 advisors, so it's like waiting for us to say stuff, and they follow the book and the process. Because most advisors, if you really look at it, are either there to sell a product and earn a commission, right? Or bring in money under management and get a fee to manage it, which is fine. But some of these brand name companies that I won't mention, the advisor sends the money to the home office and they're just a front counter person, so to speak, build a relationship, send the money to the home office. The home office decides based on a few questions where your money's going to be invested, not custom for what you're doing. And then they manage it on a regular basis. From that point on, the computer and the AI rebalances it, and you get a statement, oh, they did this, they did that. And it may be for that portfolio the right moves at that point. But the person that you're working with may or may not have any say about it. The bigger companies work like that. That would be, in my opinion, possibly. Now, maybe they have individual advisors that do just everything on their own and the home office doesn't tell them what to do. But that is a concern when you're working with big companies because they're scaling their profits. They're trying to make everything organized. And our company's they would love for me to just give them the money and let them do the buckets, and then they would make extra money for doing little work. I tell everybody and the advisors, don't do it. You want to be the one managing and picking the funds and doing everything. Even if the outcome isn't any better, at least it's more customized and the person feels like you're working for them. But when the money gets shipped off to a company, they don't know anything about you. And then if you say, oh, by the way, I need 50,000, can you liquidate some money? Then you have to take it out of a little bit of all of the funds, some of which may have a lot of gain. If you have an individual advisor managing the money themselves at this particular company or others, then he or she can say, like I did with that one I told you, I want to reallocate it, but all the damn funds are up so much. Not because I'm so great, but because it's been invested since 2010 or so. That's a fair amount of years. And so I'm having a hard time. The only ones that aren't up much are the bond funds. Well, no, we want to add to those. So the stock funds are up too much. So I've got to take off a little bit off the table. If it wasn't for taxes, I would have reallocated more, but I'm cautious about that. But we look at the funds themselves. Now we can create models in the portfolio, in the office for our clients, but we control everything in them just to make sure they fit the client more. I'm not going to gamble and say we can make more than they can at all. Maybe they can one year, maybe they can. It's not about beating the market. If you want to try to beat the market, you have to gamble or you have to leverage, right? So on real estate, you pay cash for a house, it goes up 10%. How much did you make? 10%. But if you put 10% down and it goes up 10%, how much did you make? 100%, not including expenses and all that. So it's not what you do, but it's how you do it. And so a lot of these bigger firms like this, they're fine. You're not being taken advantage of, but I would want to know the advisor actually has the authorization to allocate and manage the portfolio. We did a lecture, like I said last week. There was another advisor from another company who keeps offering me probably twice what most companies would want to buy my practice for. I'm not selling. I'm going to grow the younger generation. I want to be a pest until I'm 95. Because the house back here, I'll get remodeled. I'll come out with my walker, and they'll be, I'll be checking on them. You better do a good job. But the advisors, and I wish I could get all them here, and we'll promote that, but I don't think their employers would want them to come. But I think for them to bond and do a better relationship with you and have job security, they should be managing the money themselves. And you may call and say, what about this? I don't like this. Okay, let me take a look. Oh, that one's got that stock in it. Okay, we'll get rid of it and we'll do this. Done. But in the bigger companies, you don't get that individualized concern. And not that I always agree with clients. We had one probably 3 weeks ago. I'm really concerned about NVIDIA. It's peaked out, it's too high, and all this stuff. So we had a Zoom call. My son and I are talking to him. My son did a report where it had all the funds listed, Morningstar, and then it had an intersection page that said, of all these funds, your biggest holding is Apple and NVIDIA or whatever. Then we looked for the funds that had the most NVIDIA and then traded them out to something else. Is my client right or not? I don't know, but if he's waking up at night and really concerned about it, I want to go with what he's concerned about. And if he's right, he's right. If he's wrong, that's fine. We're diversified into some other areas. But that's my biggest complaint.
Yeah, I get concerned when I hear all of NVIDIA. I'm like, okay, and that sounds like it's going to be a problem.
Yeah, exactly.
Because if everybody's investing, and that's the big name on the street, then that's not necessarily good.
Absolutely. That's why if you buy,
doesn't it dilute the stock?
It's like the S&P 500. NVIDIA could be like 7% of the whole thing, and Apple could be 5%, and Microsoft. 7 stocks make up 30% of the S&P 500, and they have had historically bad days, right? We bought more into those, just hoping, in 2022 and 3 when technology was down a lot. Technology is down a lot only because it doesn't produce dividends today. It's more like, trust me, it'll be worth it in the long term. Bitcoin was for somebody, but if you buy it at 120 and then it drops to 60, now it's all relative with the time frame. So that's the whole point of doing the different funds. And if that's a concern, you call your advisor. He or she could run a report and tell you the biggest stock holding among all your funds. They should be able to do that with no problem. And that's something that we want to be able to meet. We have clients on both sides of the belief system. So we have to meet. Some of my clients want nothing but ESG funds. And then I told them that's great, but most ESG funds, environmental, social governance, are in technology because we don't have a lot of women on the board of oil drilling companies yet, okay? So then we would go into that direction, but I have to advise that client the risk is greater, use technology. But when technology is up, they're loving it. But you have to have that individualized conversation so you can make sure that everything works. It's like I tried this, I just returned shoes, right? Trying to buy clothes online. Good luck. She got me a refund.
That's why I only buy Prime.
Yeah.
I can easily return.
Yeah, Shaniqua returned the shoes for me. Thank you. Who would have thought my feet would be too big? But they're European sizes or something. So the investments are like that. And like I said, if you just said total stock market or S&P, forget about it, and I've got cash and some bonds, you could do that. In the long term, you wake up and you're like 300% up. But in the short term, there's times where it could be down a lot. You want to balance it out. So it's kind of like also buying a car. Which one fits your needs and what your objectives and desires are? So these are just terms. They're in the book. You don't have to worry about it. But there's like over to the right, minimum volatility. There are S&P 500 minimal volatility. They'll pick the least volatile stocks in the S&P, and you'll get them. Or a minimal volatility of large company stocks, or minimal volatility of small company. That just means they're more established and they're not as radically volatile. And you're probably not going to make as much on the upside if things are great, but you've got a little ease on the downside. Because it is a good idea to have small company stocks as well as mid-size and large. Because large company stocks are already fully inflated, full price, right? They go up and down, and if you may want them, and they tend to be a little more stable. But on the other extreme, small company stocks are unknown, they're smaller, and they have a lot more volatility. So large company stocks, in my opinion, volatility is about 16% from the norm, up or down, in a good or bad year. Mid-size, about 24% up or down. Small caps are 35%. So you don't want to just mess with that. But a good retirement portfolio should have a little bit of small caps in it, 5, 10%. Why? Because sometimes I've seen it, when large company stocks tanked, small company stocks held or went up a little bit. Go figure. Small company stocks might benefit if interest rates come down and the economy gets better, because banks don't lend to small company stocks as easily. And when the economy gets better and interest rates fall, small companies can get a little more loans to expand their business, and they might do well. So it's a million things out there to consider. Then on the right side, buffer ETFs. Again, if you're into this and want to learn every little tiny detail, there's a podcast called, I forget, ETF Prime. And they're talking about the new ETF that's coming out. All an ETF is a basket of stocks, bonds, or a combination thereof. You create it, and then you put it out into the market, and you raise some money, and then you buy the things, and then you sell your shares to investors. And your goal is, if I can grow this thing really good, if I charge 0.25% and it gets super big, that's a lot of money, right? But if I don't get big, then we might have to cash it out and send you your money back type thing. So there's a lot of different things. ETF Prime is a guy, he's a little geeky and he's not obnoxious or anything. And he talks about the new exchange traded fund. That's just a basket of stocks that is being created. And there's more exchange traded funds than there are stocks, right? So each company that creates a fund, mutual fund or exchange traded fund, is doing so hoping that you'll buy shares of it and they get a fee to manage it. So if I'm a real estate manager and I say, great, multimillionaires, I'll buy all the real estate you want without a commission. You go, that's great, okay, or I'll sell you out without a commission. You just let me manage it. That's fair enough. So they want to create a fund that you'll buy, that they'll get a management fee. They don't charge a commission to buy and sell it. Maybe a brokerage account, if it's an adversary of theirs, might charge a little fee. But generally, they're out there trying to get the management fee from running the fund. And if it's a fair fee, the ones that do nothing, they're the lowest. The ones that do a little bit, they're a little higher. And then we'll get to the ones on the top that do all the internal buy and sell, and we're going to beat the market. They charge a higher fee. You may decide, I don't believe in all these people. That's a bunch of hooey. I'm just going to go with the total stock market. And maybe some carved out niches in here of different funds that meet my needs, like total stock market, but I'd like to own an index, a utility fund or a tech fund or something else. Then they just buy one of everything in that index. And all an index is a recipe. If I create, like I said, the baby boomer index, and we decide what are all the products you buy, what are the ones you buy, what do I buy, and we say the top 50, and then we create an index of these are the top 50 stocks that we recommend to create this baby boomer index. And if all of a sudden everybody loves it, then Vanguard says, hey, can we use your index to set up a baby boomer fund? We heard that's popular. And Fidelity, Schwab, and everybody else sets up a baby boomer index fund. That's fine, but they got to pay us a tiny fraction of the management fee they get. So there are thousands of indexes out there, but the ones that we hear of are probably the top 20 or so. So anybody can create an index for the most part. And down thematic, there's ones with a theme. So you have the cybersecurity, Bitcoin, cannabis. If you buy these either before or too late, you're going to miss it. I bought cybersecurities. It went up, boom, dropped 70%. Oh no, what have I done? I looked at the companies, they're all legitimate. Now I'm back up 18% a year for 3 years. Yeah.
Ever apply, I think, a lot of this is just understanding about balancing and what all the terms and things are. But do you ever apply, like, okay, I'm thinking that this is where the world's going to go in the next 10 years, or 5 years. Therefore, I'm going to start, like, for example, cybersecurity. I think it's just going to really have major investment because of all the problems we have as a result of not enough security. Do you ever apply that kind of forward thinking? And
We do on a small scale. It's kind of like a pizza. The crust is made up of little funds like that. Well, we got to have a little bit of this, a little bit of blockchain, a little bit of utilities, a little bit of oil and energy. Yes, but we've got to be careful because by the time we start talking about it, it's already too late to buy in at a low price. Now that we're talking about it, you might buy in on it as we need to make that a part of the portfolio to be properly balanced. Yes. Or it's kind of like Bitcoin. It's too late if you bought it at 120,000. But then again, having Bitcoin on a small scale is a good idea maybe because we need that level of diversification. What you want to stay away from is working with an advisor that says, this is where we're going. This is the future of the market. Right now, $12 trillion is coming to the United States under the current administration. They're going to build data centers. They're going to do this and they're going to do that. But we've all seen that everything's planned until something gets in the way and it delays it. The cybersecurity, I bought it too early, it dropped, and it got delayed, but I hung in there long term. But what if that had been money I needed or something, and I was counting on it, and then I had to sell it at a loss? So absolutely. And the ETF Prime is a good podcast to listen to because they're talking about things that aren't really out there yet. Okay, I hear there's a new ETF. Yeah, that's a new one. Now they're getting involved in this. Well, okay, do you think it'll take off? Well, I think it will. And you get all that stuff. It's really cool. So
capitalizing on the question, the big beautiful bill had like $100 billion in defense and aerospace. That like, oh wow, that's got to take off. So would that be an impetus to buy some defense and aerospace?
As a balancing approach, yes. Way too late as a speculative, I'm going to make money there. You either have to be in on some conference, secret conference, and all these things are happening. Yeah, politician, right, exactly. Yeah.
Thank you, Nancy.
Yeah, well, like I mentioned, last year at this time, I did some research. I tried to take some time off. Went to and looked up funds and AI stocks and all that kind of stuff. Or I think it's quantum calculations. Is that the same as AI, I assume? So I came up with a list of stocks and I came up with a couple of funds. I wrote it in my notebook. I forgot about it. Intern comes in and says, oh, yeah, what about AI, man? That should be really good. And I said, well, get my binder. And I said, okay, check this out. He goes and looks at the fund. It's up 60%. You should have bought it. Well, at the time, it was an unknown, right? And it could crash 60%. So yeah, if I want to make that my gambling money or a small percentage of a portfolio just in case, because advisors have been recommending 2 or 3% in Bitcoin. Although our home office won't let us buy it because the risk was too great. There are funds that'll do it now. So, but yes, you're right, but dig a little deeper and not take headlines from what's happening in the news. Now, data centers would be one example. There are funds out there coming out, they're buying everything necessary to build a data center, right? And the nuclear plant and all that stuff. That might pan out and it might not, but that could be a nice little area to say, I think there are going to be data centers and they are going to need, because they're going to have to we don't have enough power to power them. Look at 2001 movie. They had all the information there, but we haven't gotten there yet, right? And so I don't doubt that there's going to be robots that can talk to you, but I'm not worried about it in the short term. So yes, but you be your own expert, dig a little deeper, and by the time everybody else is talking about it, you've already bought it. Now you start selling it and go somewhere else. Or it could just be something that infrastructure is a good idea because that's where $12 trillion might be going. If, let's say, the current administration, nothing happens, it takes a lot of time, they get thrown out, the new one comes in and says, forget all these deals, well, what do you think is going to happen to the data centers? All I know is I don't know. We can't predict human behavior or 100 million traders. You can't predict all that stuff. I would encourage people to stay away from tribal politics because emotionally, whatever we hear, we put a picture on it, and the other side says it's right or wrong, and we deal with all this stuff. So let me go to a few other of these. 3 layers that we talked about. The top layer is well-managed funds. Those are funds that are going to be funds that say we can do it better than everybody else. And that could be something like a T. Rowe Price Capital Appreciation is a fund you can't get into now, but it's got a good numbers. It's outperformed the S&P 500 over the long term, only because it bought the top 200 stocks, let's say, of the S&P. So they've done pretty well over the long term. But in the short term, S&Ps beat them and because they had more technology. So a managed fund is where they're going to get in. You're going to give them the money, and they're going to buy and sell whatever they think is going to be the best place to be. And we've seen over the years and decades that consistently they haven't outperformed just the averages. So I would buy the different funds in that second category if you need something that is a little more in tech or a little more conservative or is a little more fitting for you. When you get up to the top side, there's few funds up here that we think are worth it. If they're doing something that an index or a, just buy one and hold can't do, then that's fine. For example, emerging markets, they fly to other countries. These companies are good. We've looked at the manufacturing. It's legitimate. Okay, that's fine. We do Bitcoin, and there isn't a Bitcoin index yet, so I need people that understand it. So if they do something that's what you want, that isn't just buy one of everything, kind of like if I send somebody to Whole Foods and they're going to look at what I want on the list, but they can also say, you know what, I think Bill would like this. You know what, this is a new product. I think I'll do this. They have more leeway. But if I send you with a list saying don't buy anything but these things, go to Costco, it's a little bit different. So that the top rated funds, meaning the smallest portion, would be managed funds. And there are good managed funds out there. The ones semi-managed are the ones looking for the earning rising dividends. Or one that says, we're going to look for new things before everybody's thought of them. You can find those too. Fidelity's getting kind of big. iShares is getting out there. Do your own homework. Not a recommendation to buy them, but you could find funds. But I just beg of people, do a fund. One, it's regulated, and there's advisors working with it. And if something's wrong with it, we'll see it. But then you've got diversification of 45 or 2,000 stocks, and you can go with that area. So if you want to go to defense, there's a lot of defense funds out there, but it might be a little late because everybody's thinking the same way. Wow, we're going to have a lot of money invested. I could be wrong, but there are funds out there that do that. So lowest cost, little bit customized, and total freedom to manage and do whatever they want at the top. Keep that in mind. It doesn't mean that you have to follow a specific method of doing it, but just look at, if you have one big brokerage account, just say short-term, intermediate, long-term, and I want mostly low-cost index funds, but I don't want to just have total market. I want a low volatile S&P or market fund. Or international was really good in April. Anybody have an idea of why it was so good in April? International funds? Exactly. Our people panicked. Oh no, this is going to be terrible. We're going to lose all this business. And so our stock market fell overnight, where internationally they weren't worried about it quite as much because they were the one making money maybe off the tariffs and we weren't. But their stocks went up, ours went down. But long-term international stocks, I only buy them as a balance, as a seatbelt and an airbag, because they're not as growing as we are, and they're not building AI and all these other things. The U.S. market is the biggest. So like him or hate him, the current president is able to use that against these other countries because we're the biggest consumer base and we've got the biggest technology, and we've done really well in the past. So no management, a little bit of management, a lot of management, and then short-term, intermediate, long-term. If we get nothing more but that, that's extremely important. Now, what's a balanced portfolio? Either an IRA brokerage account for my IRA stuff that I rolled over my 401k stuff to, and it's still protected from lawsuits. Don't combine it with other IRAs. Then over here, we have another portfolio that's just a big brokerage portfolio. Maybe I sold my rentals or whatever. This one might have, and we looked at this a little bit before, but it might have up to 10 different fund companies, and the ones listed here, we would like to have money spread out among them for reasons I can't think of. What if they get cyber attacked, or I just want to have differences there? And one problem with being with one fund company is that if you have 4 different funds, they might have the same manager running 3 of those. And if that fund manager's run 3 of those different funds, does that fund manager like NVIDIA a lot? And each fund has similar allocations. So we run that thing when it tells us you have NVIDIA, Apple, Google, Costco, and all this stuff down here, then it tells us which funds hold those. And so if you have one fund company, you run the risk of redundancy of internal holdings. So you need to keep an eye on that. Then the other thing is...
And you said Morningstar will do that?
Yeah, the one I pay for. I don't know if
the papers go.
Yeah. And when you're done with this, if you want to do your own investing, we'll run a report and give you the facts, and then you go do what you want to do. My son will put something together, but it's nice to get that, I don't know what they call it, intersection page of, got 15 funds, and here's all the stocks held among the funds, and like I said, the top stock among all the funds, and then which funds hold that stock. And then you can clean some house if you want to. But most advisors aren't even aware of this. They don't get involved in the management of the portfolio or the money. And I'm telling you, advisors, please do this. You're going to be put out of a job. The regulators are coming in saying, what are you doing with your fee? Are you charging too much? Are you charging a fee and not doing trades that are beneficial to the client? And reallocating. How often are you talking to the client? If you don't talk to them yearly and reassess, you're not going to get paid. And if the advisor says, well, I don't know, the home office manages the money. Okay, what do you do? Well, I call the client and I do these other things. That's fine. I'm telling the advisors, job security, folks, manage the money yourself. AI, sure, it'll help us, but I want to sit down with that client and allocate things and invest and do everything based on their tolerance of risk and time and choices. And it's a better experience. It's like a custom suit. And still, you always run into issues. But so we have these different companies, 2.6% in cash, maybe more if you're planning to spend it. It might have 52% in bonds. That's pretty darn conservative. 7.2 in others, preferred stocks, 34.7 in U.S. stocks, and 2.6 in non-U.S. My son would disagree. He'd rather have like 12% non-U.S., and this is a couple of years old. So that just gives you an idea of what it might look like in the allocations. But and here's a base. If you look at this, 45% of the base is in the total market index funds. The next 40 could be factor funds and index funds and semi-managed funds that meet a little bit more of what you want. For example, defense, you might have them in that middle category because you kind of think that's the way of the future, and you can be 100% right, so you can pick up a few of these funds. Then you could go and look at the top managed part of the portfolio. That would be something that they're buying and selling, and you think they've got a good history of it, because some funds have had a good history of doing a little better than the market. It isn't a guarantee because we're banking on them moving money around, but the managed funds are the ones that will trigger tax liability if it's not in an IRA because they buy and sell. Let's see, combined portfolio. You want to also, on your Morningstar report, I want to see what the worst years were for the funds in that portfolio that I own. You may not have held it that long. You may not have owned it that long. But if I create a portfolio, and the history isn't going to repeat itself exactly, but where was it? This particular portfolio, March 28, 2008 was down 17% compared to the S&P, which was down more than 50%. That's a win, right? That's when we say, hey, guess what? You're down 17 and they're freaking out, but the market's down 50, right? So we want to see where the portfolio's been. And a lot of people call that back testing or something. We just look at the history. We can't guarantee anything in the future. Last 12 months yield net of fund expenses. So, okay, do I have yields and do I have dividends coming in? You can have individual funds reinvesting into themselves, or all the dividends can go to cash, and you or the advisor, if you had somebody, could go over and buy with all the dividends, add to a fund that's down quite a bit. Yes.
I just wanted to get a quick time check. It's a few minutes past 11:30, so we're going to try to get through this slide
Okay.
before we need to go.
Okay, I'll speak real fast and we can answer questions. Standard deviation, we want to know what the history of the volatility is. The Sharpe ratio, how much better has it performed than others, possibly. 10-year beta, how much risk? 0.38 means this is 38% as risky as the New York Stock Exchange average. So we know going in that it might be a little bit less volatile. In this case, they drop 10, we might be down 0.4 or less. R-square is something that tells you how similar it is, average credit rating, and so on. These are the things that whoever's managing your portfolio should be aware of. Then they should have some opinions. We prefer no more than 3% single emerging market funds, 5% no more than that in high yield bond funds, junk bonds, no more than 5% in a single sector like utilities, stock, technology, a little bit too much volatile. But we can do more or less based on what the client wants. 10% in any single stock fund, we call it equity. No more than 10% in any international fund or global. No more than, don't you love it? 12% in a balanced fund. No more than 15% in any investment grade bond fund.
Is that applicable to everybody, regardless of what the time frame of their investment?
For the most part, and it's just an example. Because if you have an advisor or you decide to put 30% or really high numbers, these are just general guidances. So any portfolio can have a different mix. If I create a portfolio for somebody, it's going to be a little different. But these are the safety measures, safety guards that we try to keep in mind that, look, I don't want to have any more than 15% in a single investment grade bond fund. Now, maybe I'll have 20%, 15 here and 5% there, but we just have it as a safety check. We don't want too much money in one fund just in case. It's recommendation, but your portfolio is going to be whatever you or somebody else provides. But I don't want to get caught short in, oops, I had all my money in this part of the economy and it tanked big time. Or, wow, I had more in international fund when we saw the US stocks drop. And within that month or 2 or 3, if you needed to cash money out, you don't touch the US, you go to the international that went up like 11%. I'm just saying, in this business, we've all seen it. I've done it for 45 years. If it can happen, it will sooner or later, and it'll be right out of the blue, and we'll all wonder what happened. And you can blame either party for that, but that happens. Rebalancing asset management strategy means, so these are reasons to rebalance. The client I mentioned had 70%. We want to rebalance closer to 60, but we can't do it all right now because of the tax liability. But we're getting back to a risk tolerance that she's comfortable with. Because why would you get out of what's going up? You would just go 70%, 80%. Hey, it's 90% stock. That would be great long-term for the most profit. Why would you rebalance just to say you're doing something? That's a kind of a gripe I have with advisors. But with the individual, if they are a little concerned that we have a little too much and this much risk, then we're going to dial it back. But if you say, look, I'm getting Social Security, that's the equivalent of $1 million bond, I've got a great retirement, you know what, this stuff is really for the kids, then in that other client's case, 70%, let's go to 80 as it appreciates, because you don't want to give up your profits, right? That's silly. But if you aren't going to touch it, you wouldn't, but if you might need it, you would. Because we need to allocate this stuff to make sure that it's right, and make sure it still fits. It's like exercise. If I'm an older person, they're not going to make me exercise like a younger person. And the younger person is going to get older, so as they get older, maybe you change the exercise regime. Rebalancing, so you do it for that. Market created an imbalance, like I mentioned, investors' risk tolerance. That may change. I'm getting Social Security. It's like having $1 million. Okay, let's get more aggressive. Investors' objectives have changed. Maybe they want to move, sell the house, or not. And these are just some other examples of the what we've talked about a little bit so far. How am I on time? Good? Okay. Any questions so far? At the very least, you're getting probably that you, your family member, or whoever does this should be as obsessed about it as I am. And my son is even more. So it doesn't mean that we're smarter than anybody. It just means that we focused our time in on this stuff. If you're interested in learning about what's happening, that ETF Prime is a really good place to start. There's a website or something. There's all kinds of ETF websites. And the cool thing about them is they're not trying to sell you on it for a commission. They're just saying, here's what these funds are. It's kind of like talking about stocks. That's the one thing I like, or at least maybe I'm not seeing it, is in the old days, everybody's selling you on a newsletter and buy my mutual fund, buy my annuity, and all that stuff. Now they're selling you on, we'll manage it for you, that's fine, if they're doing something that you want them to do. If I want to go on a world trip, I'd rather hire somebody and say, please, let me hire you to plan this out. But if I know what I'm doing, why on earth would I hire somebody? So you want to cover all the areas. And next week, we'll talk a little bit about estate planning and just the touch-ups and the final stuff that we're touching on here. But if you want to go deeper, you can go to the website and look at that. But make sure you go down the page a little bit to resources. Yeah, and then over to the right, there's a guy jumping up on a mountain. No, yeah, as you click there, and you can see my most recent moves on trampoline. So I'm having fun with it. It's kind of like in the early years, it's hard to get my son serious, and then I'm all serious, and now he's all serious, and I'm less serious, having fun. So yeah, but it's a kick. So if you have accounts with companies and you have an advisor, say, could we meet and you go over the portfolio and tell me what I own, what kind of securities, stocks and bonds are in there, and what the historical risk tolerance. You can get all this stuff out of the book. I just want to know a little bit more about it. I'm taking a class. And if they farm the money off to the home office, then tell them to come to our classes. Because if you like the advisor, we're happy to have them in the class and teach them how to do this stuff.
Comment, if you will, on robo-advisors from Vanguard or Fidelity.
It was a good intention going in, but when we looked at them, you would send your money to them and they'd pick like 5 different exchange traded funds and they would just rebalance it and you just do it. Tell them your risk tolerance and all that. I would do that with Vanguard or with Fidelity, and they might charge you an extra 0.25% or something, because I think they're a little more with it. Some of them, I looked at them and I looked at the portfolio, and they had you in exchange traded funds that have 0.35, higher expense ratio, and just didn't make any sense. I would rather have something put together. Vanguard will do that for you with Vanguard ETFs and funds, or Schwab might, but they're all going to charge a fee. They're kind of...
Is their personal fact-finding very comprehensive, or is it just pretty much a generic, oh, you're this old?
It's more generic, because if it was more fact-finding and it was more client-centric, that they'd have to raise the fees. And they still charge 0.35. And that's not that that's nothing, but you're not getting all the services and everything that you're doing. The thing for me is when I review everything with a client, I'm going to ask them all about, what about your trust? Is it up to date? Who are the trustees? Has anybody died? Anybody disinherited? You know, blah, blah, blah. Is the house in the name of the trust? No, it isn't. It isn't. Oh my God, we gotta. And then you go through all these questions of insurances, blah, blah, blah. Liability on the car, uninsured motorist. Okay, how much liability you got? I don't know. I need you to have 500. Uninsured motorist. I don't know. I need that to be 500, because if somebody hurts you, you get nothing. So I go all the way through the insurances. Then we get to the budget. Then we get to, do you need any money? Then we get to, what about the kids? Then we get to, all the everything down into the investments. How did you feel last April when the market tanked? And I called you and said, don't worry, you're down 10, they're down 20. We got a second shot at this. If that made you uncomfortable, I can reallocate it. That's what I did with the lady yesterday. Or sometimes they got Social Security and they inherited a bunch of money, or they didn't and they're kind of worried, and we've made good money, we need to tone it down because we could have a big downturn and you could be in serious trouble. So if you don't want to think about all these things, then work with somebody that will ask all these questions. I'm not an attorney, but I'll get the client prepared to see the attorney. And, do you have a living trust? Great. If they don't, then do you have beneficiary provisions? Great. What's the size of your estate? What if you got sued? Is your house worth more than $600,000? Because you'd be at risk. If there's a lawsuit and it's worth $1 million, they can take the next $400,000. You keep the first $600,000. So that's why you want an umbrella policy. And we have all these little things that we go through, and it's fun to know all this stuff. But the clients are just saying, "Here, you just handle it, or tell me what to do." Those are the clients that hire advisors that don't have the time. We want the student, to do it yourself as long as you can. Or by the time you decide you don't want to do it, then you beg the advisor, please, will you take me as a client? If they do all these things. Now, a lot of the corporate advisors, the companies designed to send the money to the home office, they'll worry about it, pat you on the head and say, make friends with your client, go to lunch. But if the advisor isn't in a part of all that, how are they going to be able to know everything? Or we'll look at 401ks and other things, and make some advice without charging a fee and help the client get organized to where someday they might roll the money over. So every single client is absolutely different than the other one. We can't say do this for everybody. And the companies are trying to do that. If you want to be profitable, you scale the business, right? You reduce the friction. You don't have all the work. Everybody will go into this model, or this model. Computer will sell this and buy this and sell this and buy this, and you're just in the model. And you're not getting the individualized self-care that people need, where like the bigger, wealthier people have always had. But if your advisors aren't doing that, I'm going to encourage them to think about it. And if their company won't let them, we'll take on new advisors. That's a possibility down the road. You have a lot to think about. When we're done with this class, though, you can write down specific questions. We can talk on the phone, Zoom, and say, look, check out my portfolio. I, meaning you, want to reallocate it once you get there. So we can say, here's some of the numbers. We don't do several of those because we have to work with our clients, but that's a benefit of taking the class. And it's now your job. It's almost like I'm going to stamp a tattoo on you. You have to spread the word to younger people who don't take this stuff seriously. We all think, oh, you got a new job, do the 401k, stocks. That's the last thing they need to worry about. They need to buy disability insurance. They need to buy car insurance, uninsured and motorist. I had a client get hit by a car, and the bad guy had $15,000, but because he took my advice, his company gave him $285,000, and that was back in the 80s. And had he been permanently disabled, that's all the money he would have had. So your younger people, they need disability, uninsured motorist, and travel insurance more because they have so many decades to live. If I'm disabled, it'd be sad, but I have enough funding that it's not going to, I'm not going to end up on welfare or something like that. And then if they're young couples, they have a young child, but they don't have any money. What do we need this stuff for? We have life insurance. Great. You need a will to determine who takes care of the child if something happens to both of them. So it's like a long, never-ending talk show about financial planning. Everybody's needs are different. And what's right for you isn't right for the next person. And so we can say, oh, you should have bought this 6 months ago. And people become envious. And they get that envy of, oh, I should have done that. The next time somebody says buy something, I'm going to go buy a lot of money in it. And those are the people, not you, but those are the people that lose everything. Because everything that we see in the market has had its bad days. And what makes it a bad day? 100 million people are scared and they don't buy it and the market drops. Then the traders say, hey, this is a good trend. Let's get out. And the market drops more. And then the other people get really scared and it drops more. And then the traders say, yay, okay, get back in. And then it goes back up and the traders make the money and the scaredy cats lose the money.